Did you know that selling an investment property could trigger a massive tax bill? What if you could legally defer those taxes and reinvest all your proceeds? That's exactly what a 1031 exchange allows you to do. Hi, I'm Gabe Velez, CPA and partner at Tarani Velez. Our mission is to provide you with insight into your business through transparent accounting and strategic tax planning. Today, I'm going to walk you through the basics of a 1031 exchange, practical steps on how it works, what kinds of properties qualify, and an alternative structure you may want to know about, the Delaware Statutory Trust. What is a 1031 exchange? A 1031 exchange is one of the most powerful tax tools for real estate investors. It allows you to sell a property, defer the capital gains, and reinvest those proceeds into new real estate. This lets you grow your real estate portfolio without getting hit with the tax bill. You also get some diversification, even across regions or property types, so long as they stay in the U.S., and as long as they're considered like kind. And if you keep exchanging properties over your lifetime and pass away still owning them, your heirs even get a stepped-up basis, wiping out all of the deferred tax entirely. That's what we call a swap till you drop strategy. The role of a qualified intermediary. Because most exchanges aren't direct swaps, you're going to need a qualified intermediary, or sometimes referred to as an accommodator. The QI's job is really to be the expert on the 1031 exchange and to keep track of the rules and make sure you fall within the IRS's guidelines. They're going to keep track of key deadlines such as the 45-day window to identify a replacement property and the 180-day window in order to close on that. Practical steps in the 1031 exchange. Here's what to do in practice. Number one, engage a qualified intermediary before your escrow closes from the sale. Then you sell the relinquished property and let the QI hold those funds. Make sure to start shopping for your replacement property early, even before escrow closes. Remember, you only have 45 days after you relinquish your sold property to identify your next property. Step 4 is to close within 180 days of your first sale. Make sure that the replacement property is held for investment for at least 2 years. This 2-year safe harbor strengthens your position if you're audited with the IRS. But ultimately, it is a facts and circumstances test that's going to take hold. You can still qualify for a 1031 exchange if it falls outside of the safe harbor, but it's a lot more difficult, and it's something that the IRS could challenge. To qualify for a 1031 exchange, both the relinquished and the replacement properties must be held for investment or business use. What does this mean? In practical terms, it means if the property is able to be rented, it should be rented. And rental properties is really what the IRS means when they talk about investment properties. Doesn't mean held for appreciation, and it doesn't mean you're going to flip that property. It really means that your purpose is to rent that property out. Or if the property is being used in a business, such as an office building or something like that, that also qualifies. So here are some things that are still considered like kind. So a residential versus a non-residential property would still be considered like kind because they're like kind enough. Land and land improvements might also qualify as like kind property in a 1031 exchange, even if there's not a dwelling on top of it. Certain long-term leasehold agreements or easements might also qualify as like kind property in terms of being real estate and being a qualified exchange. Things that are definitely excluded: any personal property is not eligible for a 1031 exchange. And by personal property, I mean like furniture, fixtures, computers, things like that. Also, if it's your primary residence or a vacation rental, it's definitely not going to qualify. If it's your primary residence, if it's a vacation, it probably won't qualify. Next, things like stocks or ownership in a business or LLC interest does not qualify. And then also, foreign real estate is not like kind when compared to domestic real estate. Because fractional interests in real estate also qualify as like kind property for purposes of a 1031 exchange, this opens the door for something called the Delaware Statutory Trust, or DST for short. DSTs are similar to tenant in common or TIC interests, and these professionally managed real estate investments are eligible for 1031 exchange. And the benefit of the DST is it's more of a passive investment than hands-on real estate, like managing your own rental properties. There's no responsibility to manage the property yourself. It is professionally being managed. And then it also allows for diversification across multiple properties, or maybe even some real estate asset classes that you wouldn't have access to on your own. So here are the key takeaways. Number one, a 1031 exchange can help you defer capital gains and grow your portfolio. Number two is, since most 1031 exchanges are indirect exchanges, you're going to need to engage a qualified intermediary, otherwise known as an accommodator in the real estate industry. Number three, make sure to pay close attention to those 45 and 100-day deadlines in order to stay within the window of eligibility. And number four, consider a DST if you want a hands-off investment option, or if you're cutting it close on your 45-day window. Thank you for joining me today. I hope this session has given you a practical understanding on how to accomplish a 1031 exchange. For more comprehensive and professional tax planning, please visit www.tnvllp.com/tax-planning. That's www.tnvllp.com/tax-planning.